Assalamu alaikum. Decision making is what we are discussing. The basis on which decisions should be made in organizations, how costs should be analyzed, how different aspects should be viewed to come to a most appropriate and beneficial decision. We have said that the basis of making decisions should be relevant cost basis. Normal basis includes many costs which are what we have regarded as irrelevant to the purpose of decision making. We have said relevant are those costs which are going to have some impact, which are going to change, and not the costs which are not going to change as a result of the decision. Any cost that does not change as a result of the decision is regarded as irrelevant. In order to identify the relevant costs relating to various aspects within the production process and relating to the various different costs, we have discussed and seen examples of how to view direct labor, direct material, fixed cost, variable cost, and have established that there is a particular way in which this cost must be viewed. It is going to be different in the short term and different in the long term. Many times, what costs remain fixed in the short term will not remain fixed in the long term. So we are going to, within our assumptions, within our range of time period, time frame, activity level, we are going to establish what is the best basis of analyzing information, cost information for the purpose of decision making. When we look at fixed assets, many times fixed assets and fixed costs remain the same, but very often, if you look at the longer term, they are going to change and therefore not fixed anymore. With regard to labor, we have seen that we need to even see the contribution that is being lost because of moving labor from one project and one activity to another. If we are going to move labor from one activity to another, you are going to cease an existing activity, then the lost contribution must be included as part of labor cost that is going to the new project or new activity. And similarly, with regard to material, we have seen that we need to examine the actual incremental cost that might represent an unrealized profit. It might mean that you have to look at the realizable value of material. The net realizable value is what is going to be relevant for the purpose of decision making compared to perhaps just the straightforward cost. At times we have seen that we need to look at the replacement cost. At times we have seen that we need to look at the actual future cost that is going to be incurred. We have even seen that it is not necessary that variable cost is always going to be the relevant cost. Because in situations where two projects are involved and the cost of material, direct material for both the projects is the same, then the cost of material we are going to say is irrelevant to the project and to the decision. The relevant cost is going to be that cost which is going to change. This is an important concept and it is very often needed and used in practical management activity, and by management in all kinds of organizations of every different size and nature. So it's quite important that we understand the basis and of identifying a relevant cost and identifying what is not relevant with regard to the different types of costs like material, labor, overheads, fixed, variable, etc. We are now going to examine some examples to see how the application is made when looking at some small practical examples. This is going to help you to understand and of course to be able to apply in similar situations your understanding of relevant costs. Let's look at an example now. Example in case of acceptance of a special order. The production manager of your organization has approached you for some costing advice on project Zen, a one-off project from the overseas that he intends to tender for. The costs associated with the project are as follows. Material A 4,000, material B 8,000, direct labor 6,000, supervision is 2,000, and overheads are 12,000, giving a total of 32,000. These costs have been arrived at and accumulated on the basis of normal costing. For our purpose, when we are looking at a special order, we are going to look at the basis of relevant cost. The costs that have been shown so far, these are the costs that are accumulated in the normal course of business on a normal costing basis. For example, the material cost would be the cost that you are going to incur to buy that material. The labor cost will represent the cost of labor that you are going to pay. This has not taken into account a situation whether the organization has spare capacity or it is operating on a full capacity basis. As we have seen earlier, that the costs of even labor and material would have to be looked at differently if we were in a situation of full capacity or if we were in a situation of excess or spare capacity. You ascertain the following information. 1. Material A is in stock and the above was the cost. So A is in stock, above was the cost. This cost has already been incurred. There is now no other use for material A other than the above project. Within the factory, it would cost $17.50 to dispose of this material. Material B would have to be ordered at the cost shown above. So we have seen that in our case, this material is lying in our factory. It has been acquired. It has been purchased. So this cost is the sunk cost. It has been incurred. And now, if we use this material or not, that cost, which is past or sunk cost, is not going to be changed. Furthermore, we are told that there is no other use for this material. If there is no other use for this material, it has, in a way, zero realizable value, then the relevant cost for this material, I have to ask you to think about what should it be. If it has no further use, it cannot be utilized. All costs related to it are past or sunk costs. Then this would be irrelevant to any future decision making. But not only is the realizable value of this material zero, we are also told that it would cost $1,750 to dispose of. So there is a cost involved if the company does nothing with this material, does not use it, and if it just does not use it in any other project, then it would incur a cost of $1,750 just to dispose of this material. Not only does it have no realizable value, it actually has a cost of disposal. In this case, the relevant cost would be the cost saving of 1750, which you would not incur because you use the material. So this would be a negative cost in a way, a cost saving of 1750 with regard to material A. We are told that material B would have to be acquired, it would have to be purchased, so it would be purchased at the cost that has been stated. That would be the relevant cost of material B. Direct labor costs of 6,000 relate to workers that will be transferred to this project from another. So there is some other project, and the direct labor cost of 6,000, that is the cost of these workers which will be transferred from another project. Extra labor will need to be recruited to the other project at a cost of 7,000. So what in this case should be the relevant cost of direct labor? The cost of direct labor is 6,000. You are going to remove them from their existing activity and take them onto this project. It is going to cost 7,000 to replace these workers in the existing activity. So therefore here the relevant cost of direct labor for this project is 7,000, which is in fact the cost of replacing them. So 7,000 would be the relevant cost of direct labor for this special order. Supervision costs have been charged to the project on the basis of 33.33% of labor costs and will be carried out by existing staff within their normal duties. We have talked about allocating overheads and allocating different costs to different projects by establishing a basis. Here the basis is 33.3% of labor costs. The supervision costs are allocated at the rate of 33.33% of labor cost. This is an allocation, but we are told that this supervision will be done in the normal course of duty within their normal working hours and within their normal duties by the existing staff. In actual fact, therefore, this allocation becomes irrelevant because it will not change. Staff are doing their normal duties, supervising different projects, and they will, within those duties, also supervise this new order. Therefore, in this case, this supervisory cost is irrelevant. Let's look at more information. Overheads have been charged to the project at the rate of 200% on direct labor. Again, there is a basis, and overheads have been charged on the basis of 200% of direct labor. The company is currently operating at a point above break-even. This is additional information, so you know the company is not loss-making. They are a profitable company. The project will need utilization of machinery that will have no other use to the company after the project has finished. So this machine will be acquired solely for the purpose of this project. The machinery will have to be purchased at a cost of rupees 10,000 and then disposed of for rupees 5,250 at the end of the project. The machinery for this project is going to be acquired purely for the use on this project, and the company at the end of the project will have no further use of this machinery. So this machinery will have to be disposed. We are told that the machinery will cost 10,000 to acquire, and at the end of the project it can be disposed of for 5,250. Both these are going to be impacts of the decision whether to accept the special order or not. So therefore both these must be taken into account when we are examining the relevant cost. In this case, the relevant cost related to machinery would be a cost of 10,000 and a disposal revenue of 5,250. In actual fact, the net amount should be taken as cost of machinery on this project. The production manager tells you that the overseas customer is prepared to pay up to a maximum of 30,000 for the project, and a competitor is prepared to accept the order at that price. We now have what is regarded as a relevant revenue for this project. So the production manager has said 30,000 is what the customer is prepared to pay, and that not only is that the price, but there is also a competitor who is prepared to pay this price. So in our case, it would be therefore unlikely that we can charge any price above the 30,000. He also informs you that the minimum he can charge is rupees 40,000, as the above costs show rupees 32,000, and this does not take into consideration the cost of the machine and the profit to be taken on the project. Of course, this is the information that is being provided by the production manager. And as you know, the production manager cannot be expected to have the same understanding of costs and revenues as perhaps you are. So he has said that he would like the price to be 40,000, because from what he knows, the cost at the moment related to this project is 32,000, and as yet no profit has been charged on this cost, as well as the cost of the machine has not been taken into account. Now, this will be the position of the production manager, but when you examine this, you will examine this from the perspective of relevant cost. And you will look at these costs again, and you will look at the detail, and you will try to find that for the decision-making purpose, what should be the cost relevant to this project and to this order. So the requirements in this project are: A. Cost of the project for the production manager, clearly stating how you have arrived at your figures. We need to establish what should be the cost of this project that we can give to the production manager, and we have to give the basis on which we have computed or arrived at the figures. Part B. Advise the production manager stating whether the organization should go ahead with the tender for the project and the price, bearing in mind that the competitor is prepared to undertake the project for rupees 30,000. Hence, we have to say whether or not we should go ahead and what price the company should be willing to pay. And thirdly, we are required to state 4 non-monetary factors that should be taken into account before tendering for this project. This question of monetary and non-monetary we have discussed before, and we have seen that when we are making decisions, there are certain factors which can be quantified monetarily, but there are always some factors which are non-monetary, and we have to bear those in mind at the time when we make the decisions. The cost analysis is providing us information on monetary quantifiable factors and costs. But many decisions have implications. They have implications which are beyond monetary measurement. And we looked at examples such as a redundancy in an organization. The impact that a redundancy can have on the morale of other employees might slow down activity, it might reduce productivity, and therefore it might reduce the amount of goods being produced. That in itself is going to end up becoming a cost. So when we take a decision like redundancy, we should bear in mind the impact it is going to have on the morale. And that morale is the non-monetary factor. So here in our example, we have been required to mention 4 non-monetary factors that can apply when we take a decision such as this. Other examples have been for non-monetary factors such as a customer's satisfaction. Customers might want a certain type of product. They might want a certain range of product. And when we are faced with decisions whether or not to produce and the quantities to produce, we have to bear in mind what will be the impact on the customers. So these are the kind of non-monetary factors that have to be borne in mind, and we will identify 4 of such non-monetary factors in our example of this special order. So first, let's look at the relevant costs of the project. Material A, the cost is a negative 1750. This was the cost of disposal of the material where the material had no alternative use, and by using this material in this project we are going to save the cost of disposal of 1750. Material B, we said, was going to be the cost of acquiring that material. So the straightforward cost which has been shown in the budgeted figures of acquiring material of 8,000 will be the relevant cost. Direct labor, we had said the cost was going to be 6,000, but because they are engaged on existing activity and replacing them would cost 7,000, so here the relevant cost of direct labor is, instead of being 6,000, it is 7,000. Machinery cost, we were told, was going to be 10,000 for acquisition, and 5,250 at the end of the project would be the disposal proceeds. So the relevant cost of machinery is the net cost of 4,750, which would be incurred having acquired the machinery and disposed of it at the end of the project. In this way, the relevant cost is 18,000, and the contract price, we were told, is expected to be 30,000. This gives a contribution of 12,000. So you can see what difference it makes when we examine information on the basis of relevant cost principles. The same cost which appeared to the production manager to be 32,000, when you looked at it on the basis of relevant cost principles, you found that the cost is 18,000, because first of all, material A, you knew that there is no other use, and in fact it is a cost saving of the disposal cost of 1750. In the same way, the machinery cost is taken at the net amount, and so on this basis our total cost is coming out to be 18,000 instead of the 32,000 which was calculated by the production manager. In this cost, you have also included direct labor at the opportunity cost or the replacement cost. Because your labor is engaged in a project, will be removed and brought to this project, even though you are going to pay them 6,000 here, but the cost of replacing them in the other project is 7,000. So the relevant cost for this project becomes 7,000. So now under relevant cost principles, we have been able to establish that there is a positive contribution of 12,000 in this project, let alone any question of a loss. So now, with this perspective in mind, the production manager will be given this information that accepting this project is going to provide the company with a positive contribution of 12,000 using 30,000 as the sales revenue. The notes or comments on the above calculations that you would provide are: disposal costs of 1750 are saved if material A is used in the project. Instead of there being a cost of material, there is going to be a saving of the disposal cost. Actual cost of material B represents the incremental cost. Material B is neither in stock, doesn't have any other use, so therefore the cost of buying, the incremental cost of purchase of material B represents the relevant cost. Labor costs are represented by the additional cash flow of this contract. The additional cash flow in this case is what would be the cost of replacing the labor, and that is 7,000. The net cost of purchasing the machinery represents the additional cash flows associated with this contract, both positive cash flow and negative cash flow. The negative cash flow or the outflow is the cost of acquisition, and the positive is the value of disposal at the end of the project. Supervision and overhead costs will continue even if contract is not accepted. Hence, these are irrelevant. Regarding supervision, we were told that this is the cost of supervision that will be incurred, and the supervisory staff will complete this additional work within their normal duties, within their normal hours. And therefore, the organization is not going to incur any additional cost in respect of supervision for this new project. Therefore, supervisory costs are ignored. Looking at part B, the costs given do not represent incremental cash flows arising from undertaking the contract. These are the cost of 32,000, which was given by the production manager. As the company is operating at an activity level in excess of break-even point and sales revenue in excess of 18,000, incremental cost will provide additional contribution and increase profits. Assuming that the company has spare capacity and the competitor is prepared to accept the order at 30,000, a tender price slightly below 30,000 would be appropriate. This is the basis on which we should make our decisions. We should analyze our costs into relevant and irrelevant, and on that basis we will find that there is a contribution from this special order of 18,000, and the contribution is 12,000, and the costs are 18,000 and not 32,000. So in this way, the price of 30,000, which is expected, is going to be profitable. Whereas, if we look at the information on normal costing basis, as the production manager did, he found that the cost without including profits and machinery was 32,000. And therefore, he could not accept this special order at a price of 30,000. That would have been an incorrect decision from the perspective of the company, and that would have led to a loss of this contribution that can result from accepting the order. So this is the basis that we should follow, and this is the difference that analyzing the cost and looking at relevant cost can make. Non-monetary factors. Is there sufficient spare capacity to undertake the project? These are the non-monetary factors which we have highlighted, which normally should be taken into account. They are not included as part of the cost. They are not measurable, and therefore they should be separately considered before a final decision is made. Point 2, is the overseas customer creditworthy? Another aspect, the credit checks need to be carried out. The company does not want its money tied up in receivables where an overseas customer is unable to make the due payments. Point 3, does the workforce have the necessary skills to undertake the project? Another non-monetary factor, is the workforce skillful enough? Will they be able to complete the project according to required specifications? And point 4, is the contract likely to result in repeat business with the customer? This will have its own dimensions, being able to repeat the business, and needs to be considered separately. So we have seen the non-monetary factors that need to be considered. This is always going to be the case. Your analysis, your cost information, your relevant cost principles, they will provide you with a basis to make a decision. But at all times, you must keep several non-monetary factors in mind before reaching a final decision. In our case, we looked at situations such as a spare capacity, because it will make a difference to your analysis and your cost if there is a spare capacity situation. You will look at labor cost differently. If you had inventory in stock, you would look at inventory cost differently. And therefore, you are going to have a different result by examining the non-monetary factors. Another aspect was the creditworthiness. All the factors might look very good, but where you are dealing with parties which are relatively unknown, as perhaps the overseas parties would be, their credit becomes another aspect that needs to be checked. It needs to be verified, and some credit checks need to be carried out to ensure that there is a reasonable chance of making recovery of amounts from the customer. Labor force having the required skills. Outside customers might have different demands. They might need separate specifications according to their need. So we need to be comfortable that the labor force is sufficiently skilled to provide the required specifications. The aspect of the repeat business from the customer is quite an important one. You might look at a contract or a special order in a different light if you expect that there is going to be repeat business, continued business. And if it is clear that there is going to be a continuity in business, then you might be prepared to accept a lower contribution, or at sometimes a sacrifice of contribution in anticipation of greater business that would later on result in greater profits. Now we will look at an example on deletion of a product. Blue Turban Limited makes 3 products and is reviewing the profitability of its product line. You are given the following budgeted data about the firm for the coming year. The products are A, B, and C. The sales in number of units are 100, 120, and 80. Revenues for the coming year are expected at 1500, 1440, 880. Costs: material is 500, 480, and 240. Labor is 400, 320, 160. And overheads are expected at 650, 600, and 360 for the 3 products. The total cost amounts to, in the case of A, 1550, which makes it a loss-making product, a negative of 50. Product B has a positive contribution or profit of 40, and product C has a profit of 120. The company is concerned about the loss on product A. It is considering ceasing the production of it and switching the spare capacity of 100,000 units to product C. So we are given information on 3 products. And on the basis of the information given, it appears that product A is loss-making and product B and C are profitable products. Again, here the management is faced with a decision whether or not to continue with product A or whether to delete this product and not produce it on account of its loss making. This situation again requires an analysis on the basis of relevant cost principles. You are told, 1, all production is sold. 25% of labor cost for each product is fixed. Fixed administration overheads of 900,000 have been apportioned to each product on the basis of units sold and are included in the overhead cost above. So these are fixed office administrations overheads. 900,000, they have been apportioned to the different products. But as we know, fixed costs in the short term remain fixed, and therefore discontinuing one product will not make any difference to these overheads, and they will continue as they are. So they should be regarded as irrelevant to the decision. All other overheads are variable in nature. With regard to fixed overheads, we should bear this in mind, that this is an allocated cost. When costs are allocated over different products, then the decision to continue or not should be on the basis of relevant costing, and fixed overhead cost which is allocated will remain the same even in the case of deletion of one product. If you delete a product, the fixed overheads remain the same, the costs remain the same, and this cost has to now be loaded onto the existing products. So therefore these are the kind of decisions that must be made according to the relevant basis. It would be misleading to think that deletion of one product will eliminate the losses that are shown on normal costing basis, and that would lead to a wrong decision, as we shall see in our example. Ceasing the production of product A would eliminate the fixed labor charge associated with it and 1/6 of the fixed administration overhead apportioned to product A. Increasing the production of product C would mean that the fixed labor cost associated with the product C would double. The variable labor cost would rise by 20%, and its selling price would have to be decreased by 1.50 in order to achieve the sales. This is additional information being provided on this example. We are required, A, to prepare marginal cost statement for a unit of each product on the basis of the original budget, and B, if product A is deleted. Secondly, part B, prepare a statement showing total contribution and profit for each product group on the basis of 1, original budget, and 2, if product A is deleted, and C, to advise whether product A should be deleted. So it is quite important to examine the requirements in the question, and of course we must provide precisely the information that is required by the question. In this question, therefore, we are required to provide two different statements. One statement is the per unit statement, and per unit what would be the position, what would be the cost, and what would be the profits if we are taking the entire range of the products, and secondly, if we are going to delete product A, what would be the result on the per unit cost and revenue, and therefore the per unit profitability. And the second part of the question requires us to make a statement on the contribution, on the total contribution. And again, we have to do that in two parts. One is on the basis of all the three products, and the other is on the basis of deleting product A. So on the one hand, we have the per unit cost to be looked at, and on the other hand, we should look at the total contribution. Solution, part A, selling price per unit is 15, 12, and 11, less the variable cost of material is 5, 4, and 3. Labor costs are 3, 2, and 1.5, and variable overheads are 3.5, 2, and 1.5. This gives a contribution of 3.5, 4, and 5. Fixed overheads are apportioned to the products on the basis of sales volume, and the remaining overheads are variable with output. So in this statement, we have adjusted for the costs that have been allocated. The fixed cost of 900 was allocated. We have to adjust that. And when we adjust that, we arrive at the revised position. And after making the adjustments and looking at, again, just the relevant costs, we find that product A, in fact, has a positive contribution, and that contribution is 3.5 per unit. So looking at the per unit statement and looking at all the three products, we have a positive contribution from all the three products. Part 2, now looking at just products B and C. The selling price is 12, and in case of C, the price has to be reduced, and it is now 9.5. Variable costs, materials 4 and 3, labor 2 and 1.8, and variable overheads 2 and 1.5. This gives a contribution for B of 4 and C of 3.2. The price of C has been reduced by 1.5, and variable labor cost has increased by 20%. This was the position given to us. We reduced the price of C and increased the labor cost, and the variable overhead has been increased by 20%. So we have, on the basis of information given to us within the question, we have looked at the per unit costs and revenues, and we have looked at, therefore, the per unit contribution of each of the three products in two statements. In one statement, we looked at all the three, and in another statement, we looked at just the two after deleting one of the products. The basis that is provided to us after looking at incremental costs and then seeing the decisions and looking at the contributions, of course, based on the information and the criteria provided in the question, it gives us the basis to make our decisions. And very often we'll find that when we use the principles of incremental and relevant costs, the decisions that are given or that we are likely to take are different from the ones that would otherwise be taken had we used just a normal basis of costing. This is how we need to incorporate into our decision-making process this analysis of costing. We have looked at a statement that provided information on per unit basis. Now we are going to look at a statement that is going to provide information on the total contribution basis. On the total contribution basis, for all three products A, B, and C, total contribution is 350, 480, 400, a total of 1230, less fixed costs, labor 100, B 80, and C 40, total of 220, and for administration, A is 300, B 360, C 240, total of 900. So on the total contribution basis, A gives negative contribution or negative profit of 50, B gives 40, C gives 120, total of 110. Looking at the information without product A, we will find total contribution for B and C as 1056, less fixed costs of labor of 160,000 and fixed administration costs of 850 to give a profit of 46. Fixed overheads costs apportioned to product A of 300 will decline by 1/6, hence fixed admin overheads decline from 900 to 850. In this statement, we have taken the fixed overheads and reduced them as given to us in the question, and the revised fixed overheads were used to calculate the contribution. We have seen how the profitability has changed. It has come down to 46. So this is a significant reduction in profitability by removing product A. This indicates that product A, even though apparently loss-making, was providing a contribution that was absorbing the fixed costs. It was absorbing a lot of allocated costs, and therefore it was contributing to the profits of the company. Without product A, the profits are 46. With product A, the profits were much higher, and therefore it has to be seen that including A and not including A, the decision has to be based on marginal costing basis and on a relevant costing basis, and therefore the company's profits are going to be maximized when information is looked at in this way. Part C, if product A is eliminated, the majority of the fixed cost allocated to it will continue and be borne by the remaining products. This is the important part. In our decision making, we must identify what costs are going to be transferred to other products and what costs are actually going to be eliminated. Product A generates a contribution of 350,000 towards fixed costs, but the capacity released will provide additional contribution from product C of 176,000. The question provided that if you are going to seize product A, you can increase the production of product C. And this will result in net loss of contribution of 174, because where you had contribution of 350,000 before, now you have a contribution of 176, giving you a net contribution loss of 174,000. However, fixed cost saving of 110 can be obtained if product A is abandoned as follows. Administration apportioned to A 50,000, fixed labor cost for A 100,000, less additional fixed cost for C 40,000. Therefore, there will be a net loss in contribution of 64,000. The 174,000 was the loss from contribution shifting to product C, and the 110,000 is the cost saving that you are going to get, and therefore the net loss is 64,000. Profits will decline from 110 to 46,000. Therefore, the net loss is 64,000 by eliminating product A. The advice and decision would be product A should not be eliminated even though a loss is reported. So this is the basis, and this is how I hope you have been able to see by the use of these examples that in using and analyzing information on the basis of relevant costing, the company comes to the most profitable decisions. That's all for today. Thank you very much.